Welcome to Sierra Capital's Family Office Fundamentals, a podcast dedicated to helping families preserve their legacies and wealth for future generations. I'm your host, Zev Zaretsky, Investment Director at Sierra Capital, a 25-year-old multifamily office focused on guiding ultra-high net worth families globally. In each episode, we'll explore a wide range of topics, including investments, trust and estates, family governance, philanthropy, and much more. Our goal is to provide you with a solid foundation to safeguard your family's financial, intellectual, and human capital for generations to come. Join us on this journey and stay tuned as we hear insightful conversations with industry experts and thought leaders right here on Family Office Fundamentals. Let's embark on this journey together. Please find important disclosures at the end of this podcast. All right, thank you everyone for joining us today. We have a special guest with us, the co-founder of Escalate Capital, Tony Schell. Founded in 2005, Escalate is a private credit investment manager based out of Austin, Texas, and Tony is a member of the firm's investment committee and has responsibilities ranging from sourcing deals to managing the portfolio once it's created. So to kick things off, Tony, first of all, thanks for being here. Could you share a bit about your background and your previous work experience? Kind of what brought you to the world of private credit, lower middle market, and venture?
Sure. And thanks for having me today, Zev. Much appreciated. I have a general background in finance and banking and spent approximately 5 years in a formal banking environment before I went back to get my MBA. And really the purpose was to get out of banking therefrom, but I found myself back in banking in the late 90s. But this time it was technology oriented, and I was working for a bank based out of California known as Imperial Bank, which was the primary competitor to Silicon Valley Bank. And at that point, to give you a little bit of perspective, in the late 90s, Silicon Valley Bank was approximately $2 billion in assets. So a far cry from the amount of assets under management when it failed earlier this year. Anyway, we were lending money to technology companies and those that were principally backed by well-known or established venture capital firms. And that gave me really my first taste of lending into the tech market, as well as lending into kind of private sponsored companies. And then there became a point once Imperial was acquired by Comerica Bank where I felt like we weren't taking enough risk and getting compensated for it, or that there was opportunity being left on the ground. And so I approached a venture capital firm in town, specifically Austin Ventures, and asked them if they thought it would be feasible to raise a private fund dedicated to provide what we then called senior stretch, or I think it was bastardized further to be known as Covey Light or things like that. And now it's dwarfed into this realm of shadow banking or private credit. But the idea was to really provide credit where the banks weren't filling the void. And so we set out to raise a fund dedicated to do this in 2005, kissed a lot of frogs. And by 2006, we had our second close and actually ended up closing $192 million. Of principally tax-exempt money with, again, a focus on technology companies that are venture-backed and growth equity-backed, that are generalists within information technology, and that principally means software, to be quite honest.
Yeah. So I guess if we took a step back to even prior to Comerica, what would be like a good sample of like the type of deals that you were doing?
Yeah. In truth be known, when we were getting Escalate off the ground, one of the examples that we pointed to with prospective limited partners what was really the precursor to what we now know as SaaS delivery models. Prior to the version or the word or the acronym SaaS, there used to be an acronym known as ASP, which stood for Application Service Provider. And these were software companies that sold really on a pay-as-you-go type basis. And so we had encountered a number of these types of companies at Imperial and then Comerica, and we felt like there was a void in the marketplace of providing money to companies that actually executed this type of business model. And our view was that it really changed the working capital dynamic and the needs for these companies because they wanted to reinvest really the margin that they were creating on the sales side back into the company to continue to grow. And so kind of the typical deal when we first got started at Escalate, and even again, dating back to the banking days, was a company that was growing 20% a year, was still losing money, but there was this enterprise value around what they were doing. And they typically had 25 million or more in private capital invested in them. I mean, we weren't touching pure startups. I mean, most of the stuff that we did heretofore was at least 10 million in revenue. And in fact, when we got Escalate started, one of the limited partners, it was actually General Motors, which later became Performance Equity. They wrote into our limited partnership agreement that we wouldn't finance any company less than a $10 million run rate of revenue. And at that point in time, almost 20 years ago, that seemed to be an inflection point that you could look at, that if you got past 10 million in revenue, you could demonstrate that you were a real company and there might be true product market fit. I would tell you today that that number could be a lot larger because I think with the explosion of the web and your ability to grab customers and certainly with the liquidity that was pumped into the market over the last 10 years in a 0% type interest rate environment, I think there's a lot of companies that can get to 10 million pretty quickly. So most of the stuff that I work on today typically has around a $25 million minimum run rate. We'll look at stuff less than that. We've got plenty in the portfolio that are generating less than that $25 million run rate, but that seems to be the new $10 million run rate, because to really create value that's saleable or at least, mergeable into another enterprise, our view is that ultimately it needs to be accretive and it probably needs to be pushing 50 million or more in revenue to have enough scale to make somebody interested in the asset. And certainly if you're talking about public offerings, which are few and far between these days, you need to be north of 100 million in revenue. And those are rare. They're really hard to find, or really hard to find companies on the front end that grow into that.
Well, you seem to have plenty of success doing it, so that's been positive. I'm sure you've had some big hits.
Yeah, we've. I don't have the number of companies that have gone public, but a few that come to mind are HomeAway, which ultimately became part of Expedia, and they've rebranded it back to VRBO. And actually, HomeAway acquired VRBO while we were still in the deal. Another one that comes to mind is Phreesia, which is a publicly traded company. Went public, I believe, during the pandemic. Escalate, a company out of Philadelphia, that went public during the pandemic. Another company called LDR, which is in the spinal device segment. And again, we can talk a little bit later, but we're not pure technology. We also do some healthcare technology oriented stuff. Another company called Retail Me Not that went public. And so over the years, I want to say we're north of 10 companies. So a little bit less than 10% of companies we've invested in have gone public. But again, I think that's been more of a feast or famine type situation where if the market's open and you've got scale, that's the more fortuitous opportunity for all the investors, is to try to float your shares on a public exchange.
Well, so I guess that kind of answers my second question, right? Talking about like the primary focus and who your typical clients are,
Right.
like what type of portfolio companies. So that's
Yeah,
size wise.
And yeah, let me delve a little bit more into that. So again, if we said, hey, it's a minimum of at least 10 million in revenue, again, I focus more on the upper end of that, north of 25. We're looking for companies that are growing at double-digit paces. They may or may not be burning cash, but for the most part, they're burning cash because they're investing in the business. And we can put the current economic environment aside because now we're in this environment of people are conserving cash. So there's certainly been some rigorous expense cutting over the past year. But within the sectors, we say we're technology generalists. And within information technology, for us, that historically meant a gravitation towards software and software as a service delivery models. And then on the healthcare side, it principally falls into healthcare IT, which typically means some type of software element. However, we have done medical devices, like I pointed out, LDR, a spine company earlier, or a company known as Silvergate Pharmaceutical, which was taking off-patent drugs and converting them into a liquid format for the pediatric market. But those were unique situations, or certainly Silvergate was, because it was a company that was backed by Frazier Healthcare, which is one of the predominant healthcare investors in the world. And our CEO was the former head of pharmacy for all of Walmart, which was a $20 billion business. And so when you can find situations where you've got people that you've worked with before, like a Frazier, with exceptional, management talent, which what we had on this particular CEO, and you're a little bit more willing to take some of that exogenous or idiosyncratic risk because it may represent an opportunity for an outsized return. Ironically, in that particular company, I mean, it was an okay return, but I thought it was a better opportunity for an outsized type of return in the market. So boil it back down again, technology generalists, service, and then a little bit of healthcare in there.
I guess to maybe jump around a little bit. So you're in the space every day, the private credit space. What's the general landscape right now for private credit? And so private credit firms, they typically play across, the capital stack from a senior loan to second lien to, mezz. I've seen a lot of unitranche lenders coming around. Where does Escalate typically position itself on a company's balance sheet?
Right. So we play in the space that's, I think it's best described as within that technology world at this inflection of venture capital and growth equity. So we're south of, downstream of where private equity plays, although we look at and have been involved in deals that private equity has funded. But it's really this transition from venture to growth equity where you've proven that there is product market fit, or you've got market acceptance, product acceptance. And it's now really time to step on the gas in terms of, throwing dollars at sales opportunities. Again, current market conditions have really reeled that in. But from a competitive standpoint, the folks that we typically see are other SBICs, or there's a handful of BDCs that play in our space. Horizon Technology Finance, Hercules, to some extent. There's a newer one that's come on board in the last 10 years called Trinity, who was an SBIC and now is out of the program, but is a publicly traded BDC. But at the end of the day, I think our strongest competitor is really the alternative of choosing equity to finance the company going forward. And so with a zero interest rate environment post-great financial crisis, we saw this surge of not only equity capital firms, but also the private credit firms, which that term, at least in my world, didn't exist, private credit, or it wasn't a commonly used term 10, 15 years ago. And now with the proliferation of BDCs and the shadow banking system, and I think the Volcker rules and other Dodd-Frank aspects, folks have realized that there's this market outside of commercial banks that can be developed, especially when capital was free, right? And now we're moving into this different environment where it's going to be tougher to substantiate some of those returns, and the sources of the capital for the private capital funds are going to change. But certainly partners like the U.S. Small Business Administration have got a program that's been in place since the 1950s that we're a party to. And I think it's a better match of funds for the types of investing we're doing. For example, as you know, Zev, our cost of capital, or at least 2/3 of it, is tied to the 10-year U.S. Treasury yield. Whereas when you think about commercial banks, and certainly some of the BDC players who are tied to public issuances, the banks are tied to Fed funds. We've been in this inversion for what, 18, 24 months? You write about it in your monthly newsletters. Our capital, and we can still get our 12% type fixed rates, but it's that much more competitive to the banks and some of these other BDCs than it historically was not. Meaning, during that 2012 to 2019 or 20 type time frame, the banks and the BDCs and other credit oriented groups were able to charge SOFR plus 30 or 40, and it would be something like a 6 or 7% all in yield, and we're still targeting 12% type fixed yield. Well, now we can still get that same yield for us. We've got the majority of our capital locked in with debentures that we pulled down a few years ago. And so we're enjoying this opportunity where we can be competitive to a number of players and also still get the yields we're looking for, whereas we're getting expansion, I guess, in margin, and the other players are getting contraction in margin. How long this persists, I don't know. What is the dovish comments that Chairman Powell made last week really mean? I don't know. I mean, was it really priced into the market already? Hard to say. I mean, the market was on a tear last week. It's up this morning, but I guess we'll know a year from now, kind of what the turn of events will be. I mean, do we really get the 3 rate cuts, et cetera? So hard to say, but I will say it is more competitive, but I feel better about where we sit today than I did at the beginning of the year. And part of that's because of the bank collapse. And I think we saw that as rates really started to accelerate and the yield curve moved, that we saw that people were fat and happy, if you will, and weren't ready for the velocity with which things change.
Yeah. Yeah. I guess talking about the banking collapse earlier this year, especially that SVB, right? Back in your Imperial days, they were your key competitor.
Right.
How's that shift in bank appetite and also the banks that play in your space? How has that helped or been more of a headache for you? Like, have there been more people entering the market, more banks that are taking teams from SVB or PacWest or like any of these other players coming on board, or what does the market look like because of banking collapse?
Yeah, and this is one man's view. I would say in general, I think it's more cautious with the banks. It's like when we talk to our limited partners and we talk about what happened in the spring. If you remember that Friday, I mean, I think we all left our offices thinking, oh my God, the banking system might fail, or at least a significant segment of it, meaning in Silicon Valley Bank. I was hopeful that something like what happened would happen, meaning the government steps in or there's an acquirer. And, my own thinking was it was going to be JP Morgan. Well, of course it wasn't, but the government stepped in and guaranteed everything. And then there was this, to your point about teams, there was this flurry of activity in the following weeks where teams were hired out of SVB or, because of uncertainty about jobs. And so we saw HSBC say, hey, we're going to get in this business. And by the way, I've not seen HSBC in a deal that we've looked at yet. Stifel had already begun working on building up a team, and I'm not exactly sure where they took people from, but I believe maybe some may have been from Signature Bank, which ultimately failed. And then Bridge Bank seemed somewhat stable throughout this process, but then you saw the continued doubt about the banking sector. And so there was downward pressure on PacWest, and ultimately we know they sold and got hammered into it. And there was downward pressure on Bridge Bank. But I think what I would tell you today is that I think it was 4 of the 5 deals we did this year we're more typically sitting in a subordinate position to one of those banks that we've all talked about. We're actually in a senior position. And part of that was driven by, hey, there's not much difference in rate at the end of the day. There's uncertainty about the financial institutions. And then 3, you had a loss of champions within organizations as they fled to other areas of the banking sector. But I also think that there's still potentially some shoes to drop that have nothing to do with technology that may impact banks that I think folks are maybe subconsciously thinking about. And I think that's the real estate boats that they're all sitting on. And then what type of downward pressure does that put on credit? And then you may not even be aware of this, and I'm happy to share it. And I think, you ought to get it out to certainly to your folks that you send your newsletter to within your family office business. But the OCC has come out with a communique on how they're actually going to regulate banks that have historically played in the space where we play. But in short, they're essentially saying, hey, this industry that you all that have played in the space, like Silicon Valley Bank and Comerica Bank and Bridge, et cetera, and others, we're actually on to what you're doing now. And we don't think that, just saying that, XYZ venture capital firm, or, let's pick a firm like Sequoia, just because Sequoia is in a deal, that's a good reason for you to lend money to a money losing company. And we're going to actually, require you to take more reserve or to be harsher on your grading of these assets. So we think, which it's still kind of TBD, that the OCC, and again, they regulate Comerica, I guess, SVB and their acquire First Citizens are not OCC regulated, as I recall. And I can't speak for the others, but anybody that's under the OCC purview is going to have a different lens looked upon them than previously. So our view is that makes it even, a better market for private credit in the shadow banking system, and that the banks ultimately kind of go back to what they were interested when I got into this business almost 25 years ago, or almost 30 years ago, which was, hey, we're in the business of gathering deposits. And an ugly byproduct of this business is we make these loans and we hopefully get some warrants, but we really want to use deposits to fund the rest of the bank. And that may be the impact at the end of the day, is where we see that. But I think that's certainly a piece to share with your banking constituents and certainly your clients, because that could change the landscape of how banks play in this space. And it may mean, hey, really the way you participate in this space is to actually invest in SBICs as opposed to doing it yourself.
Yeah. Well, and then you also have the SBIC structure behind you, which kind of just helps. But I guess maybe to touch on SBICs, right? You talked about how the cost of funding differs from other types of institutions. So, like, could you kind of expand on that for maybe for people who don't quite understand? All the economic benefits for the fund and the fund investors.
Right. Well, and I'm assuming a lot of your clients are aware that at a very basic level, for every dollar you put in or raise as a fund or as a private investor, you can get $2 of leverageable capital in SBA debentures within the SBIC program. The kind of limits to that are it's up to 175 million of leverage in any one fund, or 350 in a family of funds that can be outstanding. So if you wanted an optimal fund that's levered 2 to 1, you'd raise 87.5 million of private capital and secure 175 million of debentures. And what that means is you can tie 2/3 of your capital to what effectively, and this is how SBICs have been structured since we've been involved, and I assume since they started, is that it's priced off a floating U.S. 10-year Treasury. So depending on when debentures are actually issued into the marketplace or sold, you could be affected. But as we know, for the last 15 years, we've enjoyed this kind of 0 to 2% type 10-year yield. And over the past 18 months, we have seen it climb. And in fact, it pushed over 5, but now we're back into the 4s. But it's still lower than where you are on the short end of the curve, which is kind of the dynamic I keep going back to is, we're actually from a long-term or cost of capital perspective cheaper than, what you're seeing on the short end of the curve. But the real beauty in the SBIC program is not just that you're tied to the 10-year, but it's that it's fixed for 10 years. And so in the case of our funds over the past, 12, 13 years, we've enjoyed debenture rates as low as 1%. And so the ability to borrow at 1 and lend at 12, is a fabulous margin expansion. Now, rates have gone up, and so that margin has shrunk. But again, I think and believe that with some of the recent pullback, we're going to see rates in general come down. That's not just a hope and a prayer. It's a belief system that will get there. And the beauty, again, comes back to this 10-year locked period and the fact that you've got a stable partner in the U.S. government, Small Business Administration. It's actually one of the, I guess, few government programs that actually generates a profit on behalf of the taxpayers. So it's wonderful in that way. Our LPs generally like it. They're not all banks, but there's also a number of tax-exempt investors and pension funds, which they love it from the leverage standpoint, and it actually matches up well with a pension type product or a pension investor. And then for the banks, they love it obviously for the CRA credit, as well as the financial return. And many with the hopes of either, hey, I want to, bank you as a fund, or I would like to be able to participate in deal flow that you Escalate may generate. And so it's been a smattering of both.
Yeah, and I've seen that with the banks that I talk to as well. There's some banks that only want the CRA benefit. And then there's a whole other group that does SBIC investing for relationships, to get the senior loan, to get the deposits of the underlying companies that you're working with. And then also there's banks that want the relationship with funds like Escalate to do the NAV line or a capital call line, or to do the treasury for the fund and for the management company. There's definitely a lot to do there. I guess to move on to another subject. So we recently had the Fed rate decision to hold rates steady. And I know that valuations in tech, growth equity have come down significantly over the past 2 years. And so given the current trajectory of rates, now the expectation is that rates are going to be cut in 2024. What do you think is going to happen with valuations? Are the valuations of these companies that you're working with, are they going to go up? They're going to go down? We'd love to hear your thoughts.
I guess the answer is we'll see, right? It depends. Although, I was actually surprised that Powell intimated, or maybe he was strong in saying it, that there would be 3 cuts. He didn't say how much, but it could be 1/8 of a point. But at least he went out there. And so I just was hopeful he was going to say, hey, there's no more expected increases. And so he went above and beyond where I thought he would be. That certainly impacts us in terms of future debentures in the near term if we pull some leverage down. So I took that as a positive. And even our interim funding rate before debentures are priced, we borrow off of SOFR. So that was positive. But to your point on just in general there's the disconnect in realizations relative to funds coming back to market. I've had a couple of calls with limited partners and GPs and those that invest in GPs as individuals, and they all lament the same issues that look, valuations for software companies that certainly kind of the run of the mill software companies are 1 to 2x, and that's just the market we're in. Again, there's outside situations which are still going to command the 4 to 6x type revenue multiples that we saw pervasively, during the last 10 to 12 years. But it's really softened, and we need to see, a clearing out, if you will, of the inventory or what's caught up in the queue or the cash, if you will, that needs to be cleaned out. And so for us, what that means to a private credit group like us is, well, okay, we're not going to see the upside return, meaning the equity return from a change of control event or what have you. But where we look good relative to equity funds right now is DPI. And I think DPI, distributions against paid-in capital, is too often overlooked. So if we go back just a couple of years and we were at the tail end of this, bull market, people were, I believe, too heavily focused on TVPI, which included this big unrealized component, within the venture and growth equity space. And maybe it was less so on private equity. I'd like to hear your thoughts on it. But everybody was focused on TVPI and the IRR that was, a result of that. And so it didn't say it was realized or unrealized. It just said, hey, here's the IRR. Well, a lot of it was, in my opinion, I think I could speak French on this podcast, but it was bullshit, right? And so this is, in this environment where cash is king, this is where DPI, I believe, stands out, right? So, for example, we're going to, in the fund that, at Escalate, we'll actually make a couple of $1 million distribution at the end of this week, and this will be our 4th quarterly distribution of this year. We're in this cadence now where we're going to make, $2 to $3 million distributions every quarter, and that looks like, something well north of 10% kind of dividend yield on the capital that's been allocated to the credit strategy. And look, we're funding management fee out of the cash inflows that come from the interest payment collections we get, and also recycling capital. So for us, I think it's a great time to be an investor in a private credit fund of where we're focused and are playing. Now, the tough news is when if rates really do come down precipitously, and we start to see capital allocated more aggressively to equity, that's where the time and effort will be spent. And I do think that will unhinge the opportunity to have some of these exit events that are kind of waiting. But I'll tell you, we actually have got, again, mixed results, but we've got a number of companies that are in processes. We've got one, I can't release the data publicly, but we've got one that signed an LOI that at a valuation, again, it's a smaller company, but at a valuation far in excess of what I thought we'd see, or certainly in the time frame that we'd see. I mean, we've been in the deal less than a year, and we're already going to be able to trade out of the asset and make a nice return. And before you even consider leverage, it's going to be a north of 25% type return. And so to be able to put little wins up on the board is nice right now, but I don't see us actually experiencing some of the wholesale M&A and God help us, IPO opportunities until we actually see the rates come down. I mean, I don't know that just saying it's going to be good enough.
Yeah, I completely agree. It sure makes for an interesting 2024, that's for sure. So, Tony, thanks for coming onto the podcast. I really appreciate it. For anyone that wants Tony's information, it should be in the description of the podcast, or feel free to reach out to me. Tony, didn't know if you wanted to leave our audience with any final thoughts.
Look, I mean, I'm hopeful for, again, just speaking specifically as the SBIC fund manager, I'm, supportive of the program. I think it's a great fit for those that are playing in the private credit market. And I'm hopeful that we'll see, the banks look for financial return, and CRA credit might be another reason, but it's a nice, I guess, component to have on your balance sheet to allocate some capital to that may drive some outsized type return. Hopeful that within the work you're doing that there's more that'll participate in this area.
Same. Yeah, no, I think banks are great investors, but individuals as well, right? Who getting private equity like type of returns, both from the leverage and from the type of deals that you do, right? So, and you have plenty of experience doing it, and you built a great team and a great firm around it. Appreciate your time, and yeah, look forward to obviously working more with you and seeing you in person next time.
Absolutely. Well, happy holidays to you and your family, and happy New Year, and look forward to chatting in the new year.
The information presented in this podcast is the opinion of Sierra Capital and does not reflect the view of any other person or entity. The information provided is believed to be from reliable sources, but no liability is accepted for any inaccuracies. This is for information purposes only and should not be construed as an investment recommendation.